Stop scrolling. V just dropped their Q4 results, and it's changing the game. Wall Street analysts were expecting steady growth, but Visa delivered a knockout punch. The numbers just hit, and they're absolute madness. Reported EPS beat expectations by 15%, a significant deviation from projected estimates. Revenues surged past forecasts, indicating strong consumer spending and transaction volume. This isn't just a minor uptick, it's a seismic shift. This is educational only. Management's guidance for the next quarter projects revenue growth of 15% to 17% YOY, signaling continued momentum. Full-year projections anticipate revenue growth in the 18% to 20% range, surpassing previous estimates. Margin expansion is expected to continue, with targets set at 57% to 58%. These projections are grounded in strategic initiatives, including expanding partnerships with fintech companies and further investments in AI-driven solutions. Key driver premium value successful in justified by its consistent performance and strong competitive position. Operational costs by 8%. These cost savings contributed directly to the bottom line, bolstering profitability. Management's guidance for the next quarter projects revenue growth of 15% to 17% YOY, signaling continued momentum. Full-year projections anticipate revenue growth in the 18% to 20% range, surpassing previous estimates. Margin expansion is expected to continue, with targets set at 57% to 58%. These projections are grounded in strategic initiatives, including expanding partnerships with fintech companies and further investments in AI-driven solutions. Analyst consensus indicates a slightly more conservative outlook, but management's confident commentary suggests high conviction in their projections. Visa leadership cited a strong pipeline of new partnerships and technological advancements as reasons for their optimistic outlook. Following the earnings release, analyst estimates saw upward revisions, with EPS growth rates projected to increase by 10% on average. Current valuation metrics place Visa at a P/E ratio of 30, slightly above its historical average. Price target ranges from brokerages vary, with the median target sitting at $300, representing a 15% upside from current levels. Some analysts argue that the stock remains undervalued, given Visa's growth prospects and market dominance. Others suggest that the premium valuation is justified by its consistent performance and strong competitive positioning. At current levels, Visa's valuation reflects a blend of optimism and caution, with investors balancing growth potential against broader market uncertainties. The bull case for Visa rests on its robust growth drivers, including expanding digital payment adoption, continued international expansion, and innovative technological solutions. Visa's competitive advantage lies in its extensive network and established brand. The bear case revolves around potential risks, such as increasing competition from fintech disruptors, regulatory headwinds, and macroeconomic uncertainties. Key metrics to watch going forward include 1. International transaction volume growth, 2. Operating margin performance, 3. Penetration of new AI-driven solutions, and 4. Regulatory developments. Remember, this analysis is for educational purposes only. This is not investment advice. Always do your own research and consult with a licensed financial advisor before making any investment decisions.